Hello and welcome to the newsroom. Markets flat with marginal negative bias, but for 7 8 days we were doing well, so it's essentially no complaint. But you can see that in the last 30 35 minutes there seems to be a hint of marginal recovery as well. So definitely, one can see that at this point of time. 17,774, 4 5 days of constant gains for the market, and maybe this break is something which bulls would take on the positive side. Let's now welcome in our guest on the show. Trideep Bhattacharya, CIO-Equities at Edelweiss Mutual Fund is now with us. Thank you so much, Mr. Bhattacharya, for taking out time for us. What do you expect in terms of earnings season? What do you expect markets are trying to factor in, when we see the Feb and March fall and what essentially happened in April so far?
Good afternoon. Thanks to yourself for inviting me on your show. I would say our expectation or the theme for for calendar year 2023 is basically recession before rebound. Our expectation is the first 6 to 9 months of this year, we would see recessionary conditions globally, including in India. And what I mean by that is slowing growth rates. The central banks trying to tame inflation and to various degrees in different geographies. Which will materialize in some form of slowdown as we go ahead, and then eventually the economies bottom out towards the back half of this year. I think the first half, our expectation is pretty much playing as per script, where we've seen globally kind of growth rates coming off. In the central banks trying to control inflation by raising interest rates on one hand, but at the same time stop any accidents to happen in the form of banks, etc. We are standing right in front of the result season, where we would expect to see some sort of slowdown in terms of global facing sectors for sure. That's where we are right now. I think somewhere along, as we head along towards the middle of this year, towards the back half of this year, you would see this slowdown materialize in some form and respect, and then gradually economies bottom out over a period of time. The sweet time for investments or from a return point of view would lie after that. At the moment, is probably the time where we are facing headwinds rather than tailwinds.
Right. Just in terms of market valuation, how should one look at it? Just for example, IT sector, numbers are not looking that great. Management is not particularly that optimistic, but valuations are still 20-25% higher than the pre-COVID level for the sector. So how should you look at either that sector or probably Nifty in terms of valuation?
So if you take Nifty for instance to start with, the valuations of Nifty 1 year forward are roughly about 18 times. If you compare that with regards to our own history, you will find that we are broadly in plus or minus 5% around the average. So in other words, our valuations versus our own year average over the history is kind of in line. If you compare us, however, relative to the region or relative to globally, I would say that the disparity is quite high. We would probably appear a lot more expensive. Though this extent of being expensive has corrected over the last 3-4 months, but we will probably be still on the expensive side. So I think our headwind for FII flows or from a market standpoint is this relative valuation relative to globally, as opposed to our own absolute valuations relative to our own history from a broader market standpoint. IT sector is a case in point where valuations are probably there or thereabouts. The key issue is the right calibration of the earnings estimates for FY24 versus how the demand scenario might look like. And in that context, TCS presented their own views yesterday, and we will hear from Infosys today evening. But I think that is the calibration which is happening as we speak. Once that comes through, I think the sector would become probably a lot more palatable or investable from investing standpoint.
In terms of banks, how would you rate them? Would you look at banks, NBFC? What do you think is giving you more comfort now, considering that some of them have given their Q4 updates?
I think banks, if you ask me, from a slightly longer term perspective, are in a bit of a sweet spot. And when I say banks, I mean broadly speaking, lending financials. The reason I say so is if you look at where they stand today relative to where they come from over the last 3-4 years, you will notice that they have gone through a large NPA cycle, which is now reversing. Secondly, credit growth in the economy has picked up and is reasonably strong, which is usually a tailwind for banks for lending financials overall. And generally, rates have been on the way up, which is positive for their margins. So this, as a concoction, is from a fundamental standpoint, is a good place to be from a lending financial standpoint. Valuations are also reasonable as compared to many other sectors which they have got tailwind. So, on net balance, to cut the long story short, we would be positive on lending financials at this stage of the cycle from an economic point of view, and we are certainly in our portfolios overweight this sector.
In terms of new age companies, do you expect that they are trying to find their real valuation now? You think that that process is over, or just stay away because we don't know how markets would value them?
So I think the way to value companies have always remained the same. It is just that over the last year or so, we saw the new age businesses, which in essence are digital businesses, saw supernormal earnings because we all were locked up because of COVID, and hence a lot of things that we did was digitally. And hence the earnings that you are seeing in the form of these companies, when I say earnings, I mean sales growth, etc. They are supernormal in the context of where normalized growth rates are. I think as we have come out of COVID, as things are normalizing, they are probably kind of the growth rates are getting more towards normalized circumstances over a period of time. That's the first fundamental adjustment that the new age companies are going through. The second and very meaningful adjustment that they are going through is the funding environment for these companies. While earlier interest rates were at multi-decadal low, some of the long-dated earning projects also got funding. This scenario has now changed in the increased, in the higher interest rate environment, and hence going forward, the funding for the new age companies will also get a little tighter as it turns out to be. I think as we value the new age companies, these two fundamental shifts need to be taken into consideration and then need to be decided on a case by case basis where they are investable. But I would not broad brush them by saying that they need to be kept aside. Having said that, over the last couple of years, we have avoided a lot of in our portfolios exposure to this and kind of avoided a lot of downdraft. We are certainly evaluating them on a case by case basis, fully mindful of those two factors that I highlighted for you.
Right. In terms of some of the neglected sectors like names like the traditional FMCG, HUL, Nestle, or any of the pharma names, you think it's time to buy these names? They are completely neglected now for almost 2 to 3 years.
So I think it's a very fair question. Clearly, from these sectors, if you look at the end markets, the markets that they're exposed to, you will find that roughly about 30 to 50%, depending on which company you look at, are exposed to the rural sector. And at the moment, given the fact that the inflation has been high over the last year or so, and there are some headwinds with regards to monsoon that's kind of surfacing, I would surmise that over the next 3 to 6 months, the end market in terms of demand scenario might be a little more headwinds than tailwinds. But at the same time, the valuations versus that of their own history are now starting to look interesting. So basically, time to get our hunting hat on and start working on. Though I would surmise that over the next couple of quarters, results might still remain choppy, but maybe that gives an opportunity to nibble in.
Markets will look at free cash flow. Will these names come in focus, especially traditional FMCG names?
Pardon me, I couldn't hear you clearly.
Whenever markets will just focus on free cash flow, you think these names would just get re-rated?
I think these names would get re-rated the moment the outlook with regards to rural sector kind of improves a little bit, which might well be the case as we get towards the second half of this fiscal year. Because what we have to keep in mind is that middle of next year we have got elections coming about, and generally heading into elections, the rural sector sees some sort of buoyancy, maybe driven by government push and whatnot. That will be one certain catalyst to look out maybe 6-9 months down the line. And free cash flow generation clearly is one of the biggest positives that the sector has, which can't be ignored.
Right. Auto is said cyclical, but some of them also do call them that, there are a benchmark of consumption. How would you look at the auto pack? And, can you just divide for us? I mean, two wheelers have not done well for a while, four wheelers have done well, but within four wheelers, Maruti has not done well. So, can you just tell us what is the sense that you get in terms of auto ancillary EVs? How would you play that space?
I think this is in the medium term context, this is a tough sector to be in, because for the first time in the last 100 years, the sector is seeing the disruption in the form of EVs come through. And hence, stock picking in this sector needs to be kind of very carefully evaluated. That would be my first point. Coming to near term, the sector has clearly seen a bit of buoyancy over the last 6-9 months, given that we were coming out of COVID and generally people were going out, new model launches, etc. But if I look at over the next 9 to 12 months, the demand would certainly feel a bit of an impact coming from high interest costs or high financing costs for these from a passenger vehicle standpoint and whatnot. So funding would be a little more headwind over the next 12 months than what it has been in the last 12 months, and I would surmise that demand might actually come down to a certain extent. On the other side, on the two-wheeler front, courtesy their higher exposure to rural, and also the fact that inflation has already impacted them over the last 12 to 15 months, we are seeing growth rates gradually in the process of bottoming out. So some bit of uptick might come through linked to the rural uptick over the next 12 or 18 months. So that would be the other aspect to bear in mind. On net balance, I would divide this into two parts. One is the OEMs and second is the ancillaries. The OEMs could probably face a bit of headwinds driven by interest costs. The ancillaries at some point become very interesting because they have more exposure to globally, which are right now headwinds, but over a period of time, as economies bottom out, could become interesting investment opportunities. So that's how we are looking at it from our portfolio standpoint. We are underweight the sector as we speak.
Thank you so much, sir, for taking out time for us. I think we covered a whole host of sectors. What your view is, right from high P to low P to high growth to probably low growth or catalyst of growth. Thank you so much, sir, for taking out
It's
time
been a
for
pleasure.
us.
Thank you.
Let's now go across to Pratik. We spoke